When you think about investing, you probably picture two totally different worlds, right? On one side, you have this world of deep wisdom and almost intuition. And on the other, it's all algorithms, data, and cold, hard math. But what if I told you that these two paths, which seem like total opposites, are actually headed to the exact same destination? Let's dig into how they meet at one single powerful truth. So on one side, you've got the philosopher. Think of the legendary Charlie Munger. To him, all smart investing boiled down to a single, elegant idea: buy something for less than it's truly worth. It's all about judgment, it's about wisdom. Then, on the other side, you've got the scientist, the modern quant investor. They see the market less as an art and more like a system that can be decoded with process and structure. It's all about models and mathematics. So who's right, the wise old philosopher or the brilliant scientist? Well, here's the thing. The answer to that question uncovers the single biggest secret to building wealth. And trust me, it's probably not what you're thinking. Let's start with the philosopher. I mean, Charlie Munger, Warren Buffett's partner for decades, wasn't sitting there with complex spreadsheets. Nope. He relied on a completely unique way of thinking. He called his secret weapon a latticework of mental models. Now, think of it this way. Instead of just having one tool, like a hammer, and treating every problem like a nail, Munger built this incredible toolkit of ideas from totally different fields. He'd pull concepts from psychology, biology, physics, history, all to understand a single business. This was his way of avoiding that one-dimensional thinking that gets so many investors into serious trouble. And this is one of his most powerful models in action: inversion. It's brilliant. Instead of chasing success and asking, how can I win? Munger would literally flip the problem on its head. He'd ask, what are all the stupid things I could do that would guarantee I fail? And then he'd just meticulously avoid doing any of them. It's such a powerful trick to sidestep our own emotional traps. And then there's his famously blunt, sit on your ass model. Munger knew, deep down, that a lot of the time the most profitable move you can make is no move at all. This model is all about patience. It's about discipline. It's about letting incredible businesses do their thing over long stretches of time without you constantly messing with it. Sounds simple, but boy, is it hard to actually do. Okay, so now let's jump to the complete other end of the spectrum. Let's enter the world of the scientist, or as we call them, the quant. So what is a quant? Well, you can think of them as a kind of financial detective, but their main tools are math and data. They build these super complex models, not really to find the one next big stock, but to find tiny statistical edges and, crucially, to manage risk across the entire market. Now, this is where it gets really, really interesting. Look at the quant's goals here. Remove human emotion, replace hunches with process, manage risk systematically. See what's happening? They're not trying to outsmart everyone. They're trying to build a system that is basically immune to the very human flaws that trip up most investors. And that brings us to the big pivot. It turns out the philosopher and the scientist are both fighting the exact same war. They're just using different weapons. You see, the real enemy isn't the market. It's the person staring back at you in the mirror every morning. This incredible story from Morgan Housel's book, The Psychology of Money, just says it all. You have Ronald Reed, a janitor. He patiently saved what he could and invested in good, solid companies his entire life. He ended up with an $8 million fortune. And on the other side, you have Richard Foscone, a Harvard-educated, top-tier finance executive. He had every advantage in the world, but he was completely wiped out by greed and taking on way too much debt in the 2008 crisis. So the lesson here is just absolutely critical. Your behavior matters so much more than how smart you are. The janitor beat the Harvard MBA, not because he had a higher IQ, but because his temperament, his patience, his simple sense of enough was stronger. He had a better system for managing himself. And look, this isn't some rare, one-off thing. Data from India's market regulator, SEBI, found that an absolutely staggering 90% of active derivatives traders lose money. Why? It's not because they don't have strategies. It's because managing the psychology, the greed, the fear, the impatience is just incredibly, incredibly difficult. And this is where it all clicks into place. Munger's mental models and the quant's algorithms, they are not opposing philosophies at all. They are two different toolkits designed to do the exact same job, to save us from ourselves. In fact, check this out. Both Munger and the quants warn against the exact same mental trap, and they even use the same analogy, the man with a hammer syndrome. Both of these worlds figured out that relying on just one way of thinking is the fastest way to blow yourself up.
Okay, this slide right here, this is the whole enchilada. Just look at how their tools map directly to our biggest behavioral flaws. To fight impatience, Munger says, sit on your ass. The quant builds a long-term algorithm that treats for them. To fight overconfidence, Munger preaches staying within your circle of competence. The quant uses mathematical risk models. To fight emotional decisions, Munger uses inversion to focus on just not getting killed. The quant builds a systematic, rule-based process. You see? 2 toolkits, 1 single job.
At the end of the day, both approaches understand the real magic of investing, which is compounding. And compounding only needs one critical ingredient: time. A lot of it. The growth curve doesn't care how fast you are, it only cares that you stay on the curve, without getting thrown off. Staying power is everything. And if you want proof, just look at Warren Buffett. An incredible $81.5 billion of his wealth was generated after he turned 65. That's not because of a few genius moves late in life. That is the result of decades and decades of patient, uninterrupted compounding. He stayed on the curve. So, what on earth does all this mean for you? Well, it means the single most important investment you will ever make is in building your own behavioral framework. And you can start today. Read broadly, just like Munger, to build your own mental toolkit. Keep a decision journal so you can actually learn from what you do right and wrong. Study failures, not just success stories, to see what to avoid. And maybe most important of all, create rules, your own personal algorithm to protect yourself from your own worst instincts when things get crazy. Look, in the end, it really doesn't matter what you call yourself, philosopher, scientist, whatever. What matters is that you become an architect, the architect of a durable, repeatable system that is designed from the ground up to help you make good, reasonable decisions over a very long time. Because that process, that system you build, is the only thing standing between you and your own worst enemy. So, I'll leave you with this question. What's in your toolkit?